Okay, hello, welcome to Idea to IPO, our host today for startups in a down economy. Idea to IPO, as you know, is the most prolific startup organization in Silicon Valley and probably the world. It's been around for 12 years now, I believe. So if we were live, we would all clap at this point because that's a long time. In the startup world, that's like 12 lifetimes. So congratulations, Idea to IPO, and thank you for hosting this event. My name is Roger Royse. I'm a tax and corporate partner with Haynes Boone. It's an international AmLaw 100 law firm. I'm based in Palo Alto along with Gabor, who's going to be speaking today. And we do tech startups, emerging growth and venture capital. We do formations, financings, M&A, commercial contracts, and everything in between. And today's topic is going to be a little bit more business focused. We're lawyers, so we talk about the law. Of course, it's an occupational hazard. That's one of our personality defects. We're going to talk about the law, but we are going to talk a lot about just what's going on out in the market and what to expect, and what our view is, at least Gabor's and my view of what the environment is like today, and what, depending who you talk to, is or is not or may be a down economy. This is going to be a little bit Silicon Valley centric, so I'll warn you, those of you that are from around the world, but keep in mind, my experience, pretty much everybody ends up having a presence here at one time, in one way or another eventually. You're either here for talent, for markets, or for money. So here's how it's going to go today. The presentation is going to be 1 hour long, 1 hour presentation. We'll go to the top of the hour. And then Gabor is going to take questions for the next 1/2 hour, and we will close on the dot in an hour and a half. Yes, this is being recorded. It's being recorded. And at the end of this presentation, we are going to email to all of you a copy of the recording and a copy of the slides in PDF format. So if you feel like you missed something, don't sweat it. You'll have an opportunity to review it. Now, this is very important. I know you're going to have questions, and we want you to have questions, and we're going to answer your questions. Don't use the chat feature. It's just too hard to follow. There's too much stuff in it. Use the Q&A dialog box. It's at the bottom of your screen. Okay, Q&A dialog box for questions. We'll gather them up. We'll get to them in 1 hour. Okay, with that, I would like to introduce our speaker today. You get a real treat today because you don't have to listen to me for an hour and a half as usual. Today, I've got my colleague, Gabor Szecsi. He's an attorney in the Capital Markets and Securities Practice Group at Haynes Boone Palo Alto office. His practice focuses on general corporate law, commercial contracts, and emerging growth companies, mergers and acquisitions. He also advises venture funds on formation and regulatory compliance. Before joining us, Gabor was an attorney for investment firms and incubator programs in the space and defense sector, interestingly, where he gained valuable experience in sector-specific regulatory compliance. So with that, Gabor, I'm going to turn this over to you.
Thank you, Roger. If you come back for a Q&A, maybe we could form a panel. Sorry for that. So welcome everybody. My name is Gabor Szecsi, and first of all, I would like to thank you to Idea for IPO to organizing this event today, and for Roger giving me the opportunity to talk today about this very interesting topic and very interesting time we have nowadays. So today's topic is startups in the down economy. I'm going to talk a little bit about business, financing strategies, and legal matters in relation to startups and funds. First, a disclaimer: I'm an attorney, but this presentation is not legal advice. I'm going to talk about certain legal issues, but they will be in general terms. The purpose of this presentation is to help you to understand the general legal terms that helps you manage your company, negotiate with venture capitals, but because each case is different, the different cases requires different solutions. So if you have any specific legal problem, please reach out an attorney with relevant experience. So I'm going to start off with a short history of recession. This recessional period now is not the first and probably not the last. And I'm going to overview what happened in the past and what is the history of recession. Maybe we can learn something from it. How the funds, how the new fund formation work in down economy, and what was the effect of the contraction on startups. Then I'm going to talk about some contract law. If you have or startups, you have financial trouble. How can you avoid performance, or what are your options? The liability of the management could be very important in these times. You have to make difficult decisions. Sometimes the decision not necessarily in the best interest of the shareholders, and the managers may get sued. What can you do? And then I would like to close this today's presentation with some venture capital terms, mostly talking about investors' protection, investors' rights, and how the investors are managing through these times. So we are in interesting times nowadays, and I think the first question is: are we in a recession? If you look at the media, you can read various articles about it. You can get mixed messages. The New York Times said the economy is improving faster than ever. That's what they said in February. Berkeley said all systems go. The pharmaceutical technology said that the U.S. economy experiences the deepest recession of all times, and the Reuters said still no recession. But if we look at the numbers, the GDP grew 6.9% in the last quarter of 2021, and in the first quarter, the U.S. economy contracted 1.6%. So negative. We had a GDP growth of negative 1.6%. The second quarter GDP numbers are going to come out next week. I think on July 28th, we will see what they are going to report. We have heard the Atlanta Fed's prognosis 2 weeks ago. They predicted another about negative 1.5% GDP growth. And the definition of a recession requires 2 consecutive negative quarters. So if these quarters turn out to be negative, we will be officially in recession. But what does recession exactly mean? What we can expect, although no recession is the same, but past recession may give us some ideas. There were 14 recorded recessions between the Great Depressions, the 1920s, and today. Each time the depth was different, the length was different. However, there were a few common interesting patterns. And in my first section of my presentation, I would like to review these patterns. So this chart here shows the history of recession. These gray shades are the recessionary periods. There are 12 of them between 40s and 2022. This chart comes from the National Bureau of Economic Research. Also, it shows the unemployment rate, but I'm not going to talk about this. Talk about that this time. At first glance, we can note that most of recession lasted less than 1 year. If you look at it, none of them are longer than 1 year. We have in 1975 a longer period. In the 80s, that's actually an interesting period. That was it's called a double deep recession. Whenever we have an economic problem, economic turndown, people and the media likes to refer to this double deep recession period. And then we had a longer recessional period in 2008. That's the financial crisis. And we had a very short downturn in 2020 when the lockdown started. Then what caused this recession? I think that's one of the important questions to analyze our current economic environment. And if we look at the history in the 80s, after the war, we had a post-war economic recovery. The economy started to improve. There was a short boom, which resulted in a backlog of customer demand and a shortage of production capacity, and the government spending was decreased. And we had a surge of inflation. And if you look at this, it's very similar to what we have right now. We have the supply chain problems. We also have some backlog of consumer demand. It takes a lot of time to deliver the goods what you are buying, and we have some shortage of production capacity as well. How in the 50s, 55, 53, that interestingly coincides with the Korean War, and again after the war, the industry had to adjust to a peacetime environment, and instead of supplying the army and supporting the troops, it had to shift and serve the local industry. The 80s, what I briefly mentioned earlier, is a little bit different. It started in 79 with the Iranian Revolution. Iranian Revolution caused an energy crisis. The oil price went up, causing a shock in the economy. And then the economy started to improve and fell back, mainly because of the financial sector. In the 80s, the Depository Institutions Deregulation and Monetary Control Act phased out a number of restrictions on the financial practices, broadened their lending powers, caused irresponsible lending practices, and the banks rushed into real estate lending, speculative lending, and other ventures as the economy was soaring. However, by the mid-82, about 50 banks failed, and about 540 banks had serious financial problems. They were on the verge of failure. After this recessionary period, the financial sector had a very long recovery period, which ended late 90s, early 80s. In many respects, actually, this period was very similar to what we saw in 2008 in the financial crisis period. in 2001, the dot-com crisis was a little bit different. It was a rapid rise in the US technology stocks, equity valuation, value of markets grew exponentially during this period. The Nasdaq from 1,000 to rose to more than 5,000 between this period, and actually by 2000 it went back close to 1,000, and this bubble burst at some point. A lot of companies failed, burning millions of dollars or billions of dollars investors' money. So if we look at these recessional periods, we can see one interesting pattern. One is that the post-war recession periods are kind of a transitional recession periods, while in the 80s and the 2000, the dot-com and the financial crisis, recession caused by some structural problem. There was some problem in the economy, mostly the financial sector, that led to a recession. And if we are looking at what happened during the post-war economy, the supply chain problem, the backlogs in consumer demand is very similar to what we have now, and it's very similar to what we had in 2020. And the reason being is that the economy, in a way, has to adjust to the new environment. So in the post-war time, the industry had to support the military, and then they had to adjust to peace economy. In the COVID, the lockdown, we started to do more purchase online, and we didn't go out, we didn't travel, which had an interesting effect on the economy. When it opens up again, then the customer demand and the customs are changing, and the economy has to adjust to this change. The government spending usually decrease post-war time, because the government doesn't spend as much money on waging the war. Now during COVID, we had the stimulus check, the Fed's quantitative easing, repurchase operations, lending programs. Some of the lending programs still extended until the end of this year, but many of them was discontinued. The inflation was high, and interestingly, the unemployment rate were low in both periods. Looking at the sectors, businesses that are doing well were doing well during lockdown. Not accidental that the internet-based businesses were doing well during the lockdown. We started to purchase more online. The online communicating sector became very popular. Zoom, telemedicine services started acquiring more customers. The streaming services performed very well. Because we have an increased online presence, cybersecurity is more important than ever. After the last year's exceptional performance, however, we have seen the first quarter's reports from these companies, and they show the slowing performance in these industries. The second quarter's reporting period has just started. This week, I think the banking sector, financial sector reports. Yesterday, the big banks posted their reports, and next week is going to report Netflix, I think, and we are going to start to see the second quarter performance of the internet companies. and we will see how they perform. Analysts are expecting a slowing performance, which actually caused by the new industry and the changes in the customer behavior. Businesses that didn't do well during the economy or during COVID times is the energy sector. The oil sector, oil futures and natural gas futures were very interesting during COVID time. They were among the losers. The May 2020 crude future turned into negative on the last trading day. And it was mostly because of fears. I would say that one of the biggest impact on the economy and especially futures trading is the hopes and fears. And in 2020, when the lockdown started, the energy consumption and energy demand dropped. Then the producers didn't really know where the economy goes and what's going to happen with the demand. And in the meantime, the inventory started to increase. The storages reached their capacity limits. And in May, basically nobody wanted to take the risk of buying more oil, and then they have to spend a lot of money on storage if they can actually store for a long time. It was similar on the natural gas market. At some point, the natural gas price was it was below $1, and we all know what happened now on the oil and natural gas market. It's still at the oil futures is around $100, and not necessarily. It's a very complex industry. The Ukraine war has an effect on it, and of course the European and the American approach to the Ukrainian war with the regulations and sanctions all have effect on the energy prices, but this transitional period has a big effect too, because during the lockdown, the oil producers responded with closing down some rigs, and even though they are increasing production, I just looked at the weekly report. Compared to last year, the U.S. production increased a lot, but the storages and the stored oil and the inventory is still below average, and I think we can see real change in the price or the oil price and the natural gas price when the inventory is reaching the average or above average level, which takes, of course, some time. And this is the transitionary period what I'm talking about. So the conclusion is that we can say that based on the historic data that it's a transitional recession. The industry needs to adjust, which takes time, and when it happens, then we can see better numbers, better economic performance. The focus may shift to other industry segments. So while the best performing companies were the internet companies during the lockdown period, maybe their performance won't be as good as it was, and other industry segments become stronger. Historically, this transitional period are not longer than 1 year, and the recovery period is faster. So hopefully we can expect a milder recession. We don't have to experience such bad times that we have in 2008. But what does it mean for the venture capital industry? I have some more data specifically for the venture capital industry. In 2020 was a historical record. You can, if you can see, there were over 6,000 deals. The investments reached $130 billion, and 2021 was even better. 80% of the estimated $1 trillion private equity money went to the smaller companies. The venture-backed companies' aggregate valuation was $45 trillion. And based on estimates, still there is a $900 billion dry powder is available as of now. What that means, that still have about $900 billion in the hands of the venture capital funds to invest in startup companies. Some more numbers. CB Inside 2021 report said that about $621 billion VC money is available globally. And half of it is in the US and 1/3 is in Silicon Valley. So Silicon Valley is still the center and probably the best place for startup companies. Looking at the rest of the financial sector, we can see that the stock prices decreased a lot, and the publicly traded companies lost a lot of value. This is the Nasdaq historical chart, and since November, it fell about 30%. The Dow and the S&P 500 similarly show about 30% loss. And some publicly traded stocks are down 70–90% at Nasdaq. It means that the company's share price, some of them were, let's say, about $400 in November, now trading around $40. It also means if these companies recover, you can expect 10 times profits from $40 to $400. Or but if they won't recover the entire value, then you can still expect 2, 3, 4x profit. Which means that right now we can find strong companies with good fundamentals, promising future. Some of them are income-generating companies trading at a great discount at on the stock exchange. On the other hand, the venture capital investment is extremely risky. Some statistics state that only 40% of the startups become profitable, which is probably a very positive number. 9 startups out of 10 startups fail. 20% of the startups fall apart in the first year, 30% after the second year. Half of the startups close down in 5 years, and 70% of the startups dissolve within 10 years. Now, in these circumstances, a reasonable money manager would consider or may stay away from venture capital funds, because the stock markets offers great opportunities and comparable opportunities at great risks. The National Bureau of Economic Research report states that the VC return is an average 700%. Now, if you have good picks on on the stock market, on the Nasdaq, you can actually get probably comparable companies, and the stock market is liquid. You can sell the shares if you need money. If you eventually have to realize that you made a bad investment decision, you can mitigate your damage. If you are a VC investor, you tie up your money, and you can simply lose your entire investment. It's an illiquid investment. You cannot get out. Publicly traded companies already have tractions. Many of them, as I mentioned, many of them are income generating companies. So nowadays, probably for many investors, the stock market is a better option than putting their money in new venture capital funds. And this is supported by this chart that shows the fund counts and capital raised during the financial crisis. This period here shows the .com and the post.com period. This one shows the 2002, the financial crisis period. As you can see, in 2000 there were 585 funds, while in 2002 the fund count was less than half. The funds raised $88.4 billion, and only $2 billion was raised in 2002. In 2008, 443 funds were raised, and $53 billion capital were raised by these funds, and it fell to 338 funds. And also, as you can see, the capital raised was a lot less than 1 year earlier. So the recession definitely has a negative effect on the VC fundraising activity. But another interesting question: how does it affect the startup investing and the startup economy? This chart again shows the financial crisis period, and is a VC deal activity by stage, and it shows that this blue line, the angel seed count, the late VC deal count, and the early VC deal count with green. The bars are showing the deal value. So interestingly, even if the VC fundraising activity decreased during the recession period, the angel seed deal count actually increased. I would say the later VC deal count remained constant, and the early VC deal count increased a little bit. The valuation, the deal values also shows a nice increase between 2007 and 2011, although in the 2010 period was a little bit lower, but we are not seeing significant drop in deal value. So why is it that? And it goes back to the dry powder, what I mentioned earlier. The existing funds already have the committed capital from their investors. They still have the money to invest, and they actually have to. They have some pressure to invest their money because they don't want to sit the funds. The funds should work, and it should be in a good startup companies that eventually generating profits for the fund. And that's why the recessionary period doesn't really show any negative impact on the startup deals. and the startup deal activity. If the fundraising difficulties that occurs during the recessionary period have some effect, that probably it comes a little bit later, maybe 5 or 6 months later. However, if the recessionary period is mild, shallow, and short, then probably the VC fundraising activity accelerates, and it can balances out the more difficult period, and we don't see a huge impact on the VC deal activity and at the startup level. Turning to a second section of the presentation, now we can take a look at the business side, the startup side of the issues during down economy. In down economy, the company has probably less income. It's more difficult to get more customers. The interest rates are hiking, which means more expensive loans and more expensive debts. Maybe you will be unable to pay your debts because of the increased monthly payment or perform certain contracts. In this period, there are some, the Bain and company recommends reorganizing your companies around 6 urgent priorities, which I think important for you to navigate through difficult times. And probably not accidental that on the first place is to protect your employees and customers, because your business depends on your employees, and your income depends on your customers. Basically, your success depends on your employees and customers, and you have to create your recession period financial modeling around these two factors. You have to defend your revenue. Probably your revenue is not going to increase in a downturn economy. It's more difficult to get customers, so you have to defend what you have, and it is a good time to reorganize your operations, make your operations a little bit more effective. And when we are getting out of this difficult times, we are going to have more solid foundation and to build your growth upon it. If maybe it's always a good idea, but in a downturn economy, probably it's more important to find alternative financing resources, which are non-equity financing resources. You can find more and more in the US too, in Europe. The grant programs are more important, but we can see at federal level and state level a lot more programs, financial supports available for startups, for small companies. During the COVID, there were the PPP program for companies. Some parts of the program was extended through this year, still available. At federal level, the Small Business Administration has loan programs. You can check federal agencies, the NASA, the Department of Defense, the Department of Energy, and many other federal agencies has their own grant programs. So especially if you are an R&D heavy startup, these agencies have interesting grant programs, you can get a couple of $100,000 to close to $1 million or even $1 million in separate phases. It's not easy to apply though and comply with these programs. Many of you are foreign entrepreneurs, and most of the time these agencies require US citizen founders, which makes it virtually unavailable for foreign companies. But for US startups, US companies, sometimes they are very good programs. For foreign entrepreneurs, I have to say that the Regional Business Development Council have good programs. They have a budget to entice companies to their region. Here in the US, I know the Sacramento area has an aggressive Regional Business Development Council who are offering financial aid if you relocate to that area. Central Valley of California has a similar Business Development Council, but in other states and other regions have similar programs. You can find them on the internet, reach them out and talk to them. Maybe if they like your startup, they can give you some incentive if you decide to move to their region. So when you get in trouble, then you need to deal with it. And in the following few slides, I would like to talk a little bit about how you can deal with your problems. If you have debts, then you can convert it into equity. You are going to give up a portion of your company, but you are going to have more cash, and you can pay for employees. Like I said, if you have to decide between your key employees or your equity, then probably your key employees is more important. Conversion is sometimes is a good idea. I tend to be stingy with my equity, as many founders are, but there are situations when you need to realize that half of something is better than, or some percentage of something, as a matter of fact, is better than 100% of nothing. Cancellation of debt. Sometimes you can cut a deal with your creditors, and they release you from a debt obligation. The most important issue with the cancellation of indebtedness in the US is that the IRS considers it as an income, and you have to pay tax. So if the property, for example, is secured, then it is treated as sold property. If the creditor takes possession of the property, and based on if you have a recourse or non-recourse, and recourse that means that you are personally liable, non-recourse and you are not personally liable, you have to pay tax, and when you consider the debt forgiveness, you have to consider the tax consequences. Sometimes you have you have to give personal guarantees, or you have to you are going to be personally liable to your debts. We have the springing recourse guarantee structure, which means that the personal guarantee becomes effective upon the occurrence of certain conditions, like when you go bankruptcy. The bad boys guarantees are very similar. They are term the debt into it makes you personally liable in a certain circumstances. So basically, they convert the otherwise non-recourse loan into a full recourse loan. Usually fraud, misapplication of funds, unauthorized transfer of mortgage, real property, bankruptcy filing trigger bad boy guarantees. In California, I would like to just mention the California Code Section 2815, that in certain circumstances, the California law actually allows guarantors to revoke in connection to your future transactions. So you can revoke your guarantee based on California law. Some contract clauses and contract principles can help you to avoid performance in certain circumstances. One of them is the force measure, that probably one of the most well-known contract clause that allows you to terminate the agreement in certain circumstances. It was very interesting during COVID and the lockdown period. Some parties of the agreement try to terminate the contract based on force measure, and they didn't succeed. Right now, almost all force measure clauses include pandemic, epidemic carve-outs that ensure that the force measure clause will not apply in situation like COVID. We have some contractual excuses when you can excuse your performance. Where there is an enforceable contract, the parties have a duty to perform. The seller must deliver the goods, the buyer must pay for it. In other words, the duty to perform must be discharged. It can be discharged by performance, but in circumstances, you can excuse the duty to perform. And we have a couple of legal principles: the impracticability, the impossibility, and the frustration of purpose. The impracticability is an extreme unreasonable difficulty which was unexpected by the parties. So for example, if a company contracts to buy 1 million gallon of oil in the Persian Gulf, and subsequently a war breaks out in the Gulf, then this clause may apply and you can avoid the contract. However, that was an interesting case when the court explained that if subsequently, and it was actually in relation during the Gulf War period, and the court explained that if there is a war in, for example, Egypt, and the Suez Canal is blocked, forcing the ship to use an alternative route, this impracticability clause wouldn't apply merely because of the increase in cost of shipping or price increase. You cannot avoid your contract. It's when you are doing business, you are taking the risk of an increase in cost increase in price. So even 50% increase in costs have been held insufficient by the US court. The frustration of purpose is again another unforeseen event that renders the purpose of the contract valueless. And if you, for example, if you want to hold an event and rent out a place in a city, then the hurricane hits and the city becomes a disaster area, no one can attend the event, you may terminate the agreement. The school study examples are the coronation cases. This couple here is King Edward VII and Queen Alexandra. They plan to hold their coronation ceremony in July 26, 1902, but unfortunately, a few days before the ceremony, the king had a terrible stomachache, and they postponed the coronation ceremony to August 9th. Many people who came to attend the ceremony, they rented out apartments in London. Some in some case, some person rented out an apartment for 75 pounds in 1902 for 2 days, and in the other case 140 pounds for the same 2 days, which is around 16,000 pounds, and now today's value. And of course, when the coronation ceremony was postponed, they didn't want to pay for the rent, and the court held that the only purpose they wanted this contract is to watch the coronation ceremony, and because they postponed this, even the purpose of the contract was frustrated, and they could actually avoid the rent payment. The management has a responsibility to manage the company in the company's and shareholders' best interest. They have fiduciary duty that I'm going to talk a little bit more in the next few slides. And for these difficult times when you can expect interruption in your business, you can get coverage. This coverage can replace the incomes lost for the event or for contracts that were not performed, and that helps you to pay your recurring operational costs. You can cover you can cover employees, expenses, relocation, and so on. But again, it's very similar to the ever-evolving force majeure clause. The business interruption insurance agreements are also developing, and we can see more and more carve-outs. And again, we had a couple of cases during COVID, and when we saw that even if businesses paid for their insurance, the insurance company refused to provide coverage for COVID because of the carve-out that already had in place in their agreement. The D&O insurance protects the directors and officers. The directors and officers, in some, even if the company has a separate entity and limits liability, in certain circumstances, the directors and officers have a personal liability. One of these examples is the alter ego case, when the directors have fiduciary duty, and the alter ego is a legal doctrine whereby the court finds that the corporation lacks a separate identity from an individual or the corporate shareholder, and it holds that the people, the shareholders or the company managers, are basically the alter ego, or the company is the alter ego of these individuals. To avoid this alter ego problem, it's very important to not to commingle your personal funds with the company's funds, keep sufficiently accurate records, and keep the corporate formalities that actually can prove that the company is a separate entity. You have to have the board meetings regularly, shareholder meetings, have the resolution in place, and keep the records because that helps the management to protect themselves from personal liability. The managers, directors, and officers have fiduciary duties, and the duty of loyalty, duty of care, duty of good faith, and always acting in good faith are the most important duties. The business judgment rule is a protection for the business judgment rule. I'm going to talk about in a Q&A about the piercing the corporate veil. The business judgment rule is basically an interesting rule that protects the directors and officers. It's a reasonable standards, as long as the officers are acting reasonably, as a reasonable person would act under the circumstances, they can avoid liability. And now I passed 1 hour, and I would start the next section, which would be some venture capital terms. So, but I would like to stop here and not get into this topic. And if you have really questions about venture capital terms, investor protection, then during the Q&A we can discuss it. But I would like to stop here and open up this presentation to the Q&As and answer some questions if you have. So the first question, I see a lot of questions in the chat box, what I try to answer, but it's better if you put your questions in the Q&A box, because it's easier to follow. What are the implications of a technical recession, 2 consecutive negative GDP quarters, versus the National Bureau of Economic Research declaring a recession? So the technical recession, as you mentioned, is 2 negative GDP quarters, and I would say that because each recession is different, it's not necessarily a good indicator that we have 2 negative quarters, or only 1 negative quarters, or we have sometimes a negative quarter followed by a positive quarter, and again a negative quarter. I think it's more important that how this turn down effect of affects the economy, and this is the death, length, and the causes of the recession period. So if we have a good foundations, if don't have any problem in the any structural problem in the economy, then we can expect a shallower recession. That the National Bureau of Economic Research basically reports recession based on the economic indicators, and they don't have the strict rule that it has to be 2 consecutive GDP quarters. So if you are looking at the economic research data, you can get a general idea about the economic performances, but it's even if the economic performance is weaker in the given period, officially it's still not a recession. But in reality, I think what is more important is that if we are looking at the NBER's data, then you can actually get a more subtle idea about the economic performance, and you can get a better idea of the effects on the ground or on the economy. What is considered food safety business? Everything that solves the food problem, that could be an agricultural company, agricultural startups that have a revolutionary idea from agricultural production, or it could be a tech company too that solves the food problems, allow us to have more food available for us. In slide number 8, it said the oil price is negative. I'm not I'll not catch it well. Please explain. Well, it's true that happened. That was the futures trading May 2020. Actually, on that day, I was trading natural gas, and I just it was close to the end of when the future, on the day when the future expired. Almost immediately, I just switched my screen, and when I switched it back, I didn't believe in my eyes. Actually the oil future showed negative 32 dollars, and that's where they closed the contracts at that day. It actually really meant that the person who wanted to get out of the futures contract had to pay for it. Nobody wanted to buy. Virtually, there were no buyer on the market on that day. Do you think the more money giving for loans will be a negative impact on those businesses that were already struggling due to the COVID vaccination strict policies? Some couldn't thrive due to many people not wanting the vaccination and was forced to use funding just to pay bills. Now that the rules have been lowered, but many startups or pre-existing businesses are still suffering due to lack of businesses. Do you have any suggestions? Let me try to understand this question. So if I understand well, if the government would give extended loans to the startups, would help, or it would have negative effects to those businesses. I think it depends on the companies and what financing you are taking. You always need to consider your businesses, your needs, and you need to plan accordingly. Even if it is a loan, or if it is an equity round, if you need money to run your businesses, probably it could help, but you have to plan carefully, because if it is a loan, you have to pay it back at some point, and you have to pay interest, and you can get in a bad situation if you take out too much loan, and then you won't be able to pay your debt back. So the loan requires some regular cash flow that ensures that you are able to pay your monthly interest payment. if you are unable to pay, maybe it's better to get some equity financing or convertible debt, which can be converted into equity if you are unable to pay your debt, or the company is getting deeper into the crisis. But I would say the loan and also the financing is always a business decision, and it depends on what the company needs, and probably the available more loans with discounted or lower interest rate could help the companies, but I think the governments and the administration also needs to be careful not to lend irresponsibly, because it actually may indebt the companies that can ruin them actually. What are some top skills needed for entering venture capital during a recession? Advice on what to highlight in efforts to be competitive with bear hiring. That's a very interesting question. Top skills needed for entering the VC during recession. I think the question is about raising new funds, creating a new venture capital fund. If it is about fund formation, always I would say the top skills to know the industry, to know which sector you would like to enter, and you must be able to raise money, because what I just said, in a recession period, it's more difficult to raise a new fund. So probably if you are a first time manager, it is very difficult to convince investors to give you money. So I would say in the management, you must have some experienced people who have been there, who have done this business, and it can give you more respect and reputation. So I would say in bear hiring, probably the most important skill is experience, because experienced professionals are always in demand, and they are the ones who can help you through in any difficult period. Let's see what else we have. So is there an obligation to pay back angel or venture capital seed investors? Taking loans are significantly riskier, correct? The angel and venture capital seed investors are receiving, usually they get a portion of your company. So in some case you can give them redeemable shares, but as a general principle, you are not paying back venture capital investment. Nowadays we are doing at seed level and angel level, we are using safe agreements, convertible notes. If we are talking about convertible notes financing, that's basically a debt security, what you can pay back or convert into equity. But if you are converting into equity, then you don't have to pay back. Taking loans are significantly riskier. I would say not necessarily. There are advantages and disadvantages of both. If you are taking out loan, then you are not giving out equity. You don't give your companies away, or any portion of your companies away, and if you have a later round, you still have dry powder to give it to investors. But on the other hand, you have an obligation to pay it back. You pay sometimes a significant interest on the loan. I think you should consider the loan if you have a regular income. Startups usually don't have regular income, and if you are run out of cash, then you can get into trouble with the loan. So I wouldn't say that it's not a black and white issue. Which one is better? I think it's a business decision, and you have to look at the advantages and disadvantages based on your situation. Are the alternative sources of financing debt options affected by the federal fund rate? So alternative financing sources, I meant basically a grant and subsidized loan. So the Small Business Association has a loan, and they are subsidized. Yeah. In some way, I didn't even check the current interest rate. It is possible that they increased, but it's still lower than the market rate. That's the whole point of these federal funds, that they remain lower than the market rates. They are not fixed though, so it changes with the market. So I don't know if they have raised it, but it is likely that they are going to raise these funds, the interest rate, at some point, if they haven't done so. What of people from African countries like Kenya? How can we get support for startup? Some of us have project proposals that can change even the world, but we can't apply funds. Most people steal our ideas and use your personal benefits. I think there are separate issues. That's a very, very good question here. First, how can an African company get funds? Recently, we have had several startups from Africa, and if you have a good project, a good startup, American and European funders, VC funds, are happy to invest in African company. You just have to reach them out. You find them. I believe that now these ESG issues, social impact and impact investing is very popular, and because of that, companies from Africa and just maybe from Asia can get money from certain impact fund. Actually, there are here in California, I think they are, or maybe they are in Oregon, but you have to look them up. There is a social impact fund that actually they are running funds for African startups or startups in remote areas, disadvantaged areas, poorer countries. There are funds specifically specialized on that. How you can people steal your ideas? It's a general problem. You really need to talk to legal professionals. You need professional help to protect your ideas, and with contracts, and also with company policies, and know what you can disclose. So when you get in front of an investor or another business professional, and have to be prepared. I think this is one of the areas that worth the investment, because your ideas is going to give you the success. The ideas is your business, and it's imperative to protect it. Can you send? Yes, we are going to send a webinar. I think a link to the video, and we can. I think usually we send out the slides too, and other materials as well. Any advice on doing a safe post-money raise? Yes. Don't do it. Don't do the safe is very popular, so it's not the safe we like safe, and most of our deals right now is a safe deal, but at our firm, and I think it's among lawyers still the pre-money safe is more popular than post-money safe. And the reason is that if you are using post-money safe, then the investor is not going to dilute. You have to absorb all the dilution in the triggering round. And the way I'm looking at the post-money safe is very similar to the absolute anti-dilution protection in the shareholder protection rights. What we are not using anymore. Now we are using a weighted average model, usually formula, where the investor takes some dilution, and of course the funders also absorb some of the dilution. Post-safe, the company, the founders are going to dilute, and the safe investor is not going to dilute. Y Combinator advertises the post-safe is more predictable, because you know how much percentage you are going to give up, and it's more predictable for the investors. It's very good for the investors, but the pre-money safe is more funders friendly, and where it is possible, we are using pre-money safe, and I recommend everybody to keep using pre-money safe if it is possible. Most of the time, it's the post-money safe is everywhere, and it's not necessarily the terms determine which one you are going to use. It is just seems more available in the industry, but if you are aware of the difference between pre-money and post-money safe, and you approach the investor that from the beginning that you would like to use a pre-money safe, then most likely you can get this. You can convince the investor to stay with the post-money safe, and I think it would be much better for you. The conversion, when it comes to conversion, the conversion calculation is very complicated, and it's not always obvious how to calculate and what numbers you can use. There are some arbitrary numbers in the formula that you have to apply. which is not good. The pre-money is still clear formula, conversion formula, and still you can actually predict what the investors is going to get, especially if you have a valuation gap, then you can make a model calculation. So I recommend the pre-money save to everybody. What about an assessment for near worst case? For example, recession or depression going for the next 2 or 3 years. My assessment is that the current situation is more based on a high cost of energy, influenced by a current US energy policy and the Russia-Ukraine war. Yeah, if you remember the chart what I showed you, the recession period usually takes 8-11 months. When we have a structural problem, it took longer. So I don't think this recession or depression period is going to last 2 or 3 years. True that even if in each period the recession period was less than a year, it was followed by a slower recovery. So if you look at the dot-com crisis, we had about, I think the dot-com crisis actually was an 8 month or 8 or 11 month recession period, but the post-recession recovery took years. But this long post-recession recovery period took years because of the huge dislocation in the technology market. Many companies went bankrupt. A huge amount of money was burned with the bankruptcy, and it took time to rebuild that value that was lost. Here we don't really have this kind of structural problem in the economy. The companies are not going bankrupt, and we don't see the financial sector's troubles either. What we had in 2008, what we had in the 80s. So even if it is my opinion, and I don't expect 2 or 3 years of recovery or bad period this time. And the cost of energy, yes, the cost of a high cost of energy is definitely one factor, but like I said, there is other factors and which add to this whole complex thing, the supply chain problems, the food price, the backlog of consumer demands, is all add to this whole economic issue, and the Russian-Ukraine war is only one factor. So even if the Russia-Ukraine war takes 2 or 3 years, I don't think that is going to determine the next few years' economic performance. Yes, we are going to share the slides. Thank you for answer to my question. To get grants, it is possible to get grants and loan to pay off other loans that will allow you to invest more in your businesses. Usually, the grant programs are for a certain purpose, to a certain projects, and the way you use these grants are predetermined. You have to use it for the project, and many times you won't be able to use the grant money for salaries, for example. They are giving the grants to develop a prototype or develop your product further. Maybe like I said, the regional business development councils have a budget to help you. They have more flexible programs, and they can actually give you money that you can use freely. And if that's what you need, you can actually use for paying out your debts too. But you need to reach them out. Actually, I think the regional business development councils are very helpful, and they have a lot of useful tools to help startups. I have some more questions. I already run out of the 1.5 hours, but I would like to answer these questions. 3 or 4 questions left. It's a good question. What is a good amount to invest in a startup to be in good standing legally and ensure there is a good turnaround? So when you invest, when you are raising funds, you have to consider a couple of different things. You have to consider your business plan, how much money you need, and how far the money takes you. Usually the investors would like to see your business plan, and the investors want to give you just enough money to reach your next milestone, and then in the next round they give you some more money to reach another milestone. That's how the different the different series are follow one another. So and I think this is a good idea, that you need a business plan in place, and you must have a couple of milestones, how you are going to reach your goal, and what would be the each separate step. That's the business side of the fundraising. And there is a legal side, because whenever you are raising funds, you have to comply with the securities laws, and startups routinely rely on exceptions, because securities laws require you to, Section 5 of the Security Act requires you, if you sell a security, you have to register unless some exception applies. And there is one popular exception for startups. If you are an issuer selling your shares, and this share is not a public offering, then you don't have to register your shares. But what is not a public offering? Interesting questions, and then eventually the SEC and the APs, to avoid litigation over the issue of public offering, created the Regulation D, what is a well-known safe harbor. If you comply with these rules, then you can ensure that you meet the exception. But the problem with fundraising is that complying with the exception, you might break up your investments, smaller batches of funds, and start a series of investment, which if you consider in an aggregate wouldn't qualify for the exception. So that leads us to an integration rule, which is very complicated. But the idea is that for securities purposes, you need to plan your financing needs at least for a year period, and when you run a fundraising, then you must have sufficient money to operate for a while without the need of a follow-on financing. As a rule of thumb, I would say that you have to keep 6 months 6 months between each fundraising, so you must have enough funds from the investors to operate for 6 months. So that's if you could reach the milestones shorter, you still need to consider that you have to allow more time between each fundraising for securities law purposes. What are some pros and cons of starting company now in software, SaaS, and metaverse? Well, I wouldn't say that we have pros and cons. If you have a good idea, it's I think software, SaaS, and metaverse are very good industries. Maybe the pros are the increasing competition on this in this sector, and there is an increasing competition. Then of course it's more difficult to raise funds. Sometimes VC funds turn you down just because they already have 5 or 6 similar projects in their portfolio. What we have seen actually, if you are talking metaverse, it reminds me of Facebook. When Zuckerberg were raising fund for Facebook, he was turned down by the best Silicon Valley fund managers, only because they already had a couple of other social media platform projects in their portfolio that all eventually, as we know, went belly up, and Facebook survived. So so the competition could be one disadvantage, but software and SaaS and metaverse are I think they are it's a very good industry, and I like it, and if I were a fund manager, probably I would keep them in my portfolio. How much approximate fees to start and maintain a for-profit and a non-profit company per year for legal? That's an interesting question. It depends on the area where you are and your legal needs. I think this is one question that you should discuss with an attorney in your specific case. In general, I would say that to setting up a non-profit in the US is considerably more expensive than a for-profit company, because of the application for the non-profit status is kind of complicated, and it requires a lot of paperwork. The maintenance of a non-profit requires more reporting. In California, you have to file the tax return with the California Attorney General's office. You need filing for Secretary of State. You need a tax return, and you need more detailed and accurate reporting for tax purposes. So it's obviously more expensive to fund, maintain than a for-profit company. A for-profit company maintenance cost, of course, it depends on the company's business activity. When you don't have business activity, you have to pay a state franchise tax, even if you don't have to. They are saying, like Delaware says, that you don't have to pay tax in Delaware, but you still have to file an annual report and pay franchise tax. And you still need some accounting for filing the tax return. So you have certain fees. It's not much, I would say, that just maybe above $1,000 a year to maintain a company, including fees and taxes. Okay, I run out of questions in the Q&A and already run out of time. So I'm closing this presentation. Thank you very much for your attention, and I hope you like this presentation. You learn something from it, and if you have a question, please feel free to reach me out either via email or on LinkedIn. I'm happy to continue this discussion with any one of you. Thank you very much. Bye.